All right, let's start. I'm assuming y'all get these emails. So there's some pretty important stuff. I don't know who Cavaldi Ferguson is, but KPMG accountants, y'all know they're here tomorrow. And then FDIC, they've been recruiting our finance majors. The State Department, JP Morgan Chase is here
today or Thursday?
Thursday. That would be a good one to go see. Yeah, y'all get these emails? Look familiar?
I haven't seen that, no.
Yeah, you should be getting something. So I don't know where you sign up for them. Some of you are getting, so watch that. Second thing, finance majors, if you walked into a interview today, what's the obvious thing you should know about markets today? Dropped a lot, a little?
The S&P was down like
and what is a lot or what is a little? I think even non-finance majors, you should know what's going on. So the S&P is down almost 2%. If you remember from your stats class, what one standard deviation means, that's a kind of a rare event. So one standard deviation on the daily stock market's about 1.2%. So 1.9 is a pretty big day. And then even more so, the 10-year treasury is up 14 basis points. We'll talk more about basis points. A one sigma event on the 10-year treasury is 6.5 basis points and it's up 14. So this is like a 2 sigma event for the 10-year treasury. What happens to bond prices when yields go up? We'll talk about that. Is that a good day for the bond market? So Yahoo Finance doesn't understand bonds because they have it in green, but it's actually a bad day for bond markets. Interest rates go up, bond prices. So it's a pretty bad day. Why is it a bad day? We had a bad inflation reading today. I think people are talking about the headline number, but I think the market's focused on the core number because the core number was horrendous. The core was 3.9% over last year. The headline number is only 3.1 because energy prices have come down. But yeah, so if I were walking into an interview, so there's probably about 8 or 9 statistics, economic statistics that you probably want to track if you're a business major. CPI is one of them right now. CPI can be somewhat boring when, so a lot of these statistics, no one cares unless they surprise and then become a big deal. So this is one everybody's focused on. We're hoping for a 2.9 number and we got a 3.1 number. That's pretty good if you compare it to like the UK or some other countries that are really struggling, but it's still not the number people are looking for. And so that one number is causing markets to really, really tank today. So yeah, if you don't know which factors to watch, I can give you a list of the ones the market's most sensitive to. I would certainly be aware of those. The other thing, so I've got these jobs out here. I don't think anyone's applied to any of them, but I don't know if you're not interested. So what I can offer is if you're like, I'm not sure, then give me your email and I'll send your email to the people hiring. And then they'll email you and set it all up. That way you don't have to take the initiative. They'll do it. If I were you, I'd just be applying to everything just to get the practice. So there's a marketing job, there's a management job, there's a finance job kind of, and then there's a finance job. So yeah, I'll keep putting them out there, but if you have any interest at all, just go for it. If I were you, I think the statistics are you need to apply to 100 places to get 10 interviews to get one job offer. So it's a 10%, 10%, 10%. So I would probably be applying to 5 to 10 companies a day, especially in the fall semester. But even now, I'd be doing 10 companies a day, just constantly applying. And you got that Russell 3000 file I sent you? If you sorted by industry, just sort it by the biggest companies and just apply to the biggest companies and just go down the list and just keep applying on their websites. I would do it over and over again. It's a volume game right now. Students are getting hired. Companies like UTSA, they love our students, especially honor students. But if you apply to 10 places and don't get an offer, doesn't mean you're a failure. It just means it's really tough. There's a lot of competition, so it's really is a volume thing. Just I made that mistake when I graduated. I only applied to like 3 places. Fortunately, one of them offered me a job, but that's unusual. The next thing is Cap IQ should be working in FSC now for every machine, so we can test that out and see. I'm hoping you're going to use Cap IQ even after this class because it is an incredible resource, a lot of valuable information. So can't think of anything else. Any questions or anything? So before we do margins for Walmart, just remember on turnover, if they all work, you can just leave it in there. But if square feet's not working, just highlight it and hide it. So I gave you employees and PP&E. Those are the fallbacks if you can't find any others to use. So like Dolby, I was looking up Dolby to see what's that for Jacob. Yeah, just to see if they had any kind of subscription. I was, Adobe probably does, but Dolby didn't have anything. But then when I did the Statista, the number one turnover ratio that came up was revenue per employee, which is probably what Dolby uses. That's a probably pretty common one for tech companies. So it works pretty well. Now, Cynthia's doing Exxon. Well, Exxon, they have something called proven reserves. They might do revenue per proven reserves. The problem with Exxon is they do oil and they do gas. So they have to have this thing, which is somewhat of an oil to gas equivalent. How much oil it equates to a barrel of oil, and they have to make that adjustment. But the nice thing about Exxon is, as hated as energy companies are, if you go to their website, they have this free PowerPoint that they provide to all their investors that has all the ratios they follow, and you can see what ratios they actually follow. So for a firm like Exxon, there's probably a turnover ratio very specific to Exxon that they use, which is probably not what we're using, but revenue per PP&E would work fine for an Exxon. All right, so let's jump into margin. Margin is usually pretty straightforward. I used to have 3 things on the margin. And there's one that students really hated, so I just took it out. It's one I really like, but I took it out. So I left you with 2 really easy ones. Gross margin and net margin. Gross margin should be really stable for your company. If you have a company with a volatile gross margin, I'd be really interested to see what that company is. It should be pretty stable. If you can look at Walmart, their gross margin is 25%, which sounds pathetic, but that's just the nature of their business. And you can see it's been very, very stable, 25% forever. Below the industry median, but you expect that with a Walmart, you'd expect that with a Costco, very low gross margins. Now, Ferrari, I don't know, Peyton, can you see Ferrari's gross margin?
Real quick, it's pretty high though.
Probably 70% or something. It's probably.
No, it was about 20 to 30.
Oh, was it? Okay. Well,
no, I think it's like I don't know. The gross margin.
Yeah. Car companies, the net margin can be like single digits, and Ferrari probably has a double-digit net margin. Gross margin, yeah, it could be. Tech companies, it can be 70-80%. With Ferrari, it's probably
60%.
Yeah, it can be much higher because they don't really have a product to sell. It's really, I mean, who even knows what's in their cost of goods sold? So 25%, you can see you have to have the industry. You can't compare this against all companies because you got such a hodgepodge. So 25% is probably pretty decent for a Walmart. If you looked at Walmart versus Target versus Costco, Target's probably the highest, Walmart the next, Costco the lowest. But they are also in the exact opposite order when you look at asset turnover. This is one, it's probably good to put the 90th and 10% in there if you can. It would be pretty interesting. I think with Ferrari, they probably look really strong versus the industry, so it'd probably be a good one to put in there. It shouldn't be too skewed. Net margin, this is where you get a lot more volatility. So their net margin, as you would expect, is below average, just the nature of the business. So, but it doesn't look like it's declined much, but that's actually a fairly significant decline. So when you look at net margin, and you look at the decline, don't think of that it's going from 4.9 to 4. Don't think of that, only fell 1%. That's actually like a 20% drop. That's a pretty significant drop. Now, obviously it jumped a bunch because of COVID, but if you look historically, their margins had been over 5.5%. And now they're down to 4%. That is it doesn't sound like a big drop. It has a huge drop. From 5.5 to 4 is a huge drop in net margin. Now, what is Costco? Is just 3 all the way across. Costco is actually going from like 3 to 3.3, which is a pretty decent increase. But so Costco is extremely flat. Walmart's come down. Probably there's some Amazon impact competition going on here that's impacting them. So net margin, long-term decline and falling behind industry. You see the industry was somewhat catching up in a bad way to Walmart, and then Walmart has just kept going down. Consistent drop in margins. So that's it. On margin, it's pretty straightforward. You're looking at the trend. Is it up or down? You're looking at versus the industry. Higher is better, lower is worse, although you have to have some comment on the industry itself. So there's margin and turnover. Most firms, if they're strong on margin, they're going to be weak on turnover. If they're strong on turnover, they're going to be weak on margin. It's hard to find a firm that's strong on both. There are some, like a Meta, that for a while there was just strong on both because they had this network platform advantage, but it's not too common. You have to be careful if you have a commodity-driven business. I don't have Valero here, but Valero on turnover can be really, really deceptive because their revenues are going to go up and down with oil prices, gasoline prices. And it looks like, wow, their turnover went up a bunch, and then it goes down a bunch. But the problem with Valero is their revenues and their cost of goods sold move up and down like that. And so it looks like their revenue did really well, but their cost of goods sold is up because they had to buy oil. So with a firm that's very commodity sensitive, I tend to not use revenue for my turnover ratios. I tend to use gross margin. So I have revenue minus cost of goods sold, because with Valero, the revenue is going up and down with oil prices, so their cost of goods sold, but the gross margin is fairly stable. So if you want to look at their turnover, you probably want to use the gross margin in dollars. So there's a few industries that have some tricks to be careful of. Now, the one thing I used to do with margin that I don't need anymore is I like to look at the growth in revenue versus the growth in EBITDA. And what I want to know is earnings keeping up with the growth in revenue. And I like that ratio because if revenue is growing 10%, you would expect margins to be growing 20% because you'd expect some fixed costs. Their revenues are up, but their earnings are up more because they have fixed costs. But that's not true for most companies. Most companies, their revenues grow 10%, their margins only grow 8% or 7%. Most firms are struggling. So I've took the chart out because it's just so hard to explain. Well, that's a chart that USAA used. The CEO, Bob Davis, used that to restructure USAA, laid off 25% of the workforce, because we had something we call the alligator chart, where they showed growth in revenue and growth in expenses, and expenses were growing like that, and revenues were like that, and it looked like an alligator mouth. And Bob Davis was like, we can't compete if our expenses are growing faster than our revenues. And it got pretty bad at USAA. It's probably bad again now, but USA's expense ratio was like 30%. Expense ratio, expenses to revenue was like 30%. Geico was like 18%. Progressive was like 19%. USA was almost twice the competition. You can't compete if your expenses are twice the competition. So that's why they laid off 25% of the workforce. And now they're back up even bigger. So they brought it all back. But keep that in mind. That thought process of, and we can look at Walmart, their revenues are growing 2.81%, but their EBITDA is actually flat. So they're growing their revenues, but their earnings are not growing, which means their margins are what? Shrinking. So why is that? Why? And the revenues aren't growing much. They're growing essentially in line with inflation, which we said that's pretty bad because they're also adding stores. So revenue is pretty weak, but then their earnings are not even keeping up with that. So Walmart is certainly struggling quite a bit. You kind of expect that given the competition in this industry. I'm impressed with Walmart. I think they've actually come back and had done some exciting things. Amazon's not quite as successful as people think because they're not all that profitable. So it'd be interesting to see next 10 years what's going to happen. I hope they both go out of business. That's my opinion. I hope someone better comes along and completely kills them. And they're, I like competition. I like new firms coming in, doing it better and wiping out the previous players. I think that'd be wonderful, but I don't know who that would be. Are there any major players going on right now
For which company?
in the retail area? Are y'all shifting your business to someone else?
What about e-commerce? Like, that's separate.
Are there
Like,
retail, I mean, e-commerce only businesses on retail that you're using
a
more?
lot of people use like, and it's like, of course, like products, it's like way cheaper.
Are they producing them or are they finding them somewhere else? And that's part of the thing with Amazon. I used to think Amazon was just the middleman between all these producers. So they actually have these massive warehouses where actually producing things. So it gets back to that value chain. A new competitor is going to be better because they have some advantage in that value chain, whether it's how they procure stuff, how their operation to build stuff, how they distribute it, how they market it. They have to have some huge advantage in those areas. That's why I love the podcast of Healthy HelloFresh, whatever that thing is, and how they're trying to be the best in everything on the value chain. That's a new business that you want to look for. Somehow they do things a lot better. They can get the same things accomplished with lower expenses. So AI might help you with that. Robotics might help you with that. Have y'all been in a fast food with no employees yet? There's a couple of them in California. Y'all seen those things?
Like it's completely automated?
Huh?
It's completely automated?
Yeah, there's nothing but robots and kiosk.
Not even like.
I think a manager said, they said a manager comes in every once in a while just to make sure the robots aren't goofing off, but it's essentially just robots producing hamburgers. And I don't know if it's cheaper because the robots are pretty expensive, but there's not an ongoing cost of the robots. There's no training. So, we'll see if that's going to be the thing of the future. We as consumers benefit, but, we'll see how big of an impact it has. All right. So there's margins. Margins is a fairly easy one to handle. So remember on liquidity and solvency, we summarize that by looking at credit ratings. On turnover and margin, you're going to summarize that fairly straightforward is you're just going to multiply them by each other. Asset turnover times margin, it's essentially return on assets. That's why you bring them together. So you can see Walmart was strong on turnover, weak on margin. When you bring them together, they're right in line with the industry, but declining. In fact, they are the industry. The whole industry seems to move with Walmart. So you just bring them together. Are they getting better? So what you have to do on chart 13, this is where students really struggle in this paper. Look at the shape of chart 13 and try to figure out why is it doing what it is. Is it more due to turnover? Is it more due to margins? Which is having the bigger impact? So if we look at Walmart, we see that it's declining. Say, why is it declining? Well, their asset turnover has actually risen a little bit, but their margins are down CAGR of 3%. Now, I wouldn't use those actual CAGRs. I don't like CAGRs of ratios, but it shows you most of the decline in asset turnover times margin. It's all due to margin shrinking. They're holding their own on turnover. They're strong on turnover. They're doing well on turnover, but its margins is where they're struggling. That's why their revenues are up 2.8%, but their earnings are actually down. What could Walmart do to improve margins? Well, they can't just increase prices because they've got competitions like Target, like Costco out there. So the other alternative is what? Reduce your expenses. How can they reduce expenses? So that's where robotics, and I don't think the self-checkout line is saving them a lot of money. Those are just a mess when you go through them, but I love them. They save me a lot of time, but does it really save them time? They have a lot of theft and those type of issues in those lines, which is, just trying to figure that side out. But I don't think home delivery and curbside is going to reduce your expenses, but it's possible. You'd have to look at how many workers and those kind of things. So what could Walmart do to reduce expenses? Because they're probably not going to increase their prices in this competitive environment, but they definitely have a problem. You know, if their margins were where they were in the past, and watch what I'm doing here. You can just say, hey, what if their margins were still 564? Their asset turn times margin would be exceptionally good. The return on equity would be exceptionally good. You can't actually see what would that impact be. So the reduction in margins is definitely. So you're trying to figure out what's the biggest issue I have here. So we know McDonald's is very good on liquidity. They look acceptable on solvency. They're strong on turnover. What's their one big issue? It's margins. They got a margin issue. So you're trying to get to that. Where do we want to focus? The way I think about your paper is, let's say Walmart just hired you as their next CEO, and you got to go in, you got to work on something. I would probably start with margin. Right, so you finish it up by just talking about asset turnover times margin, and you're trying to figure out what's the biggest thing to focus in on. All right, so I'm curious if any of this is stuck. So I gave you a template that I think is really good. So who's going to impress me and be able to give me the entire template off the top of their head?
For the paper?
Yeah. You start with looking at what? Liquidity, which is part of what? Short-term viability. All right. After liquidity, what do you look at? Solvency. And then what do you do after short-term viability? Long-term, not long-term viability, but what do you focus in on the long term? You know they're going to be around for 5 years, so now you're focused in on growth. And what's the two things we look at there? How do firms, without looking at your notes? So what are the two things on their long term? We just talked about the second one.
Margins.
Turnover and margins. Yeah, I mean, that's the model. So liquidity, what do we look at? You looked at CFO growth, look at net working capital requirement, you looked at how they're using their cash for any evidence of free cash flow solvency. We looked at the ability to pay debt times interest earned and the level of debt to EBITDA. We summarize that up with credit ratings. Long-term growth, you look at revenue growth itself. You look at growth versus capacity. So their revenues have grown, but how are they getting that? Are they getting that with more traffic, which would be better turnover? Are they getting that because they're adding more stores, which would be adding capacity? And then you just look at asset turnover margins. We're just looking at gross and net margins. And then you summarize that with ATO times margin. So that's the model. Does anybody use this? So when Bob Davis became CEO of USAA, I was in this perfect position. It was pretty hilarious. Bob Davis just would pick someone as their person, and you never know who that was going to be. And so my first meeting with him, he wanted to hear about investments, and my boss had a golf game and he didn't want to do it. And my boss was so mad at me because I just kept talking. I was like, this is the CEO. I'm going to talk as long as I want. My boss was like, I got a golf outing, but I just kept talking, and that somehow had a connection with him. So I got really in with, he kind of saw me as the investment guy somehow. I wasn't the best guy at USA, but I won that argument. So when he came in, the first thing I told him, I said, Bob Davis, USA has a very serious liquidity issue. And that's the first thing he worked on. USAA had this property and casualty company with hurricane exposure, earthquake exposure. They needed a lot of cash in case they had $1 billion catastrophe. And yet USA was dumping money where? Theme parks, right? Fiesta, Texas. They're building high-rise senior living. It was just cash was going everywhere. And so you had this company with all these huge liabilities, but with less cash. So we fixed that first. And then I got involved on a project on solvency. How much net worth does USAA need? So that was the second thing he worked on. He went out of order because the next thing he worked on was margins. He says our expenses are way too high. So that's when he cut the staff 25%. Y'all may not remember that. It was big in the news here in San Antonio, but maybe before you were alive. But yeah, first time in USA's history, they've actually had a major layoff. And then he started focusing on turnover, and he started using a word that was like a cuss word at USA. He started using the word sales, and the customer representative says, we don't sell stuff at USA, we serve the member. And he says, well, fine, you're going to start selling stuff now. And he told them, hey, if someone calls the bank for an auto loan, you need to transfer them over to the property casualty company to buy auto insurance. If someone calls to add someone to their whatever to their policy, send them over to the life insurance company to buy some life insurance. And guess what happened to USA's sales? They shot up. And that's when USA started. Have y'all seen USA's advertisements everywhere? I see them a lot. Maybe it's because I'm tied to them, but they used not to advertise at all. Now they do. So Bob Davis, he only got one out of order, at least from my model, but he went liquidity, solvency, margins, turnover. And he wasn't a very popular CEO because he was pretty rough, but there's absolutely no doubt USA's financial numbers soared and did incredibly well under his CEO leadership. So he followed this model, and he never took my class. So this is a pretty common model. So the last thing we want to do is bring all these together. We're going to bring solvency, turnover, and margins all into one overarching analysis. And that's when you get the profitability ratios. You may have seen this before, but it's going to be different. So we're going to combine turnover, margin, and solvency. So return on equity, there's a lot of different definitions. I'm keeping a really simple one. It's just net income over your net worth or owner's equity, whatever you want to call it. Net income over owner's equity. A lot of firms will do net income over average net worth. And then the question is, how many averages? Do you just use end of year last year and this year? So 2 points. Some do monthly and do like a 13-point average or whatever. We're not going to do that. We're just going to take this year's net income over this year's ending net worth, just to keep it simple. So it's the return on equity. It's essentially, it's the return the shareholders are getting. How much net income are they getting versus how much they invested in the firm? The problem with return on equity is it has good stuff in it and bad stuff in it. We need to separate the good and the bad. We need to somehow break it up, because firms can get a higher ROE by doing stuff that's really not good at all. But if you load up a lot of debt, loading up debt usually makes your return on equity shoot up, but that's not a good reason to increase your return on equity. So how do we break this up? And so good at DuPont, y'all may have heard DuPont ROE decomposition. You might have had that in an accounting class. I'm going to show you the way finance does it. But DuPont, and I don't know who at DuPont came up with this. Their name's still on it. It's a good process. It's a really good model. But essentially what they said is return on equity, if you break it into its pieces, it's asset turnover times margin times the tax piece. We want to break the tax piece out because the IRS, you know, whatever the tax laws are, they are. Stockholders are probably not going to invest in the firm because they have really good tax accountants. You want to have good tax accountants, but if your net income's high because your tax accountants are doing a really good job, their management is probably going to jail at some point. So there's a limit to what you can do with the tax. So let's break that out. So that's not a big impact. And then let's take the debt piece out. The debt piece has two pieces: the interest expense part and the actual leveraging that debt does. The interest part hurts you. If you borrow money, you got to pay interest. That's going to bring your net income down. But the debt helps you because you use debt instead of equity. So your ROE looks a lot higher because you're using debt. But this makes the firm riskier. For most firms, the leverage impact is much bigger than the interest impact. And so for most firms, using debt, just borrowing money makes your ROE go up. But management is not adding value by just borrowing money. They add value by doing what? Improving asset turnover, improving margin. That's where you want management adding value. Now, what are these formulas? So you know these formulas. Asset turnover is sales over assets. I'm going to take the sales over assets. Margins, remember asset turnover, you got sales divided by whatever is in the ratio. So asset turnover is sales over assets. Margin is, the EBIT margin is margin you divide by sales. So EBIT divided by sales is your net margin. The tax impact is net income over earnings before tax, because what's the only difference in these two? This one's before tax, this one's after tax. Now, don't answer this too quickly, but if your tax rate's 30%, what should that ratio be? So if your earnings before tax is $100 and your tax rate's 30%, what's your net income going to be?
Shouldn't it be 80 bucks? Or 70 bucks?
$70, right? So your earnings before tax is 100, you pay 30% in tax, so your net income's 30. So what is that ratio going to be? I mean, your net income is, sorry, let me say it again. Your earnings before tax is 100, your tax rate's 30, so your net income is going to be 70. So what's this ratio going to be? 70%. So it's going to be 1 minus your tax rate. All right, so that should be 1 minus your tax rate. And then when we do the interest in this piece, the interest impact is earnings before taxes over earnings before interest and taxes. The only difference in these two is your interest. This is before interest, this is after. So Lululemon doesn't have any debt or hasn't had any debt. So what would their ratio be? Should just be 1, shouldn't it? They don't have any interest expense, so earnings before interest and taxes and earnings before taxes should just be this, that should just be 1. What happens as you increase your debt, increase your interest expense, this ratio is going to fall below 1 and start bringing your ROE down. And then the very last one is the leveraging impact of debt. So assets versus net worth. Debt is a big difference in those two. So if you add debt, this gets levered up and it's going to increase your return on equity. Now let's look at these. Here's cells and the numerator. There's cells and the denominator. My high school algebra teacher used to call those one-sters. You can multiply anything by 1, you get the same thing. So he called them one-sters. There's a one-ster. Here we have assets in the denominator, and we have assets in the numerator, so that cancels out. Here we have EBIT in the numerator. Here we have EBIT in the denominator. Here we have EBT in the denominator. Here we have EBIT in the numerator. What are we left with? Net income or net worth. So some students are like, well, why do we go through all this trouble? Well, because we're trying to put it into the pieces. We have good stuff. We have stuff we can't really control. And we have stuff that just increases risk. It does increase return on equity, but just makes the firm riskier. And we'll see later, if you leverage up the firm, yeah, return goes higher, but you're riskier, so your required return goes higher. Your stockholders say, hey, you're riskier, so you need a higher return. You say, well, we got it. But why did you get it? Well, because you took more risk. So it's you're kind of chasing yourself. You have a higher return, but you needed a higher return because now you're riskier because you have all this debt. So true management added value is asset turnover and margin. That's why that 1 ratio is just so critically important. The ATO times margin, that is really, I'm sorry, wherever it was. That's really the key to what management's doing. You can see Walmart is not doing well there. It's been declining pretty dramatically because of the drop in margins. And on the debt side, if the firm's return on equity is higher than our cost of debt, adding more debt is going to make your ROE go up. Not because management's doing a good job, it's just because that's what debt does. Now, I've seen accounting classes that say this is an actually good thing, that management's adding value by adding debt, and that is not true in finance. Accountants tend to ignore the fact that this makes the firm much riskier. We don't consider that a good thing. Just adding more. I mean, does that sound right in your personal life? You're going to add more value in your life by taking on more debt. I would argue it's the exact opposite. You should be avoiding debt as much as you can, especially as you're younger, because it's something you have to take care of no matter what. You can think of all the people with those student loans, and boy, the student loans came back on, and that's having a havoc on a lot of people's lives. So firms taking on debt, it's somewhat of a hindrance to their business. All right, so let's look at this last section on Walmart. And what I did for you on line 43 is I built the ROE decomposition there. So I have asset turnover and margin, and then I combine those. I have the tax impact. You can notice with Walmart, it should be around 65%. It kind of fluctuates around 65, 68. It should, because the corporate tax rate was 35%. Now, Trump had his tax change in 2017. You might see some jumps around 2017 because of that. You may be surprised that cutting the corporate tax rates actually makes people's taxes go up. There was some bizarre adjustments that had to go on, but generally it's around 70%. Not everybody has those kind of tax rates. To me, a really fascinating firm is Carnival Cruise Line. So their income, well, I can't get pre-COVID, so sorry. So if I could get pre-COVID, I could show you, but I can't show you this. But Carnival Cruise Lines, if you look at it, they pay essentially no tax, completely tax-free. How do they do that? I'm not exactly sure. I do know y'all probably wouldn't go on a cruise. It's a really boring. I've been on 2 cruises. They're really boring, but I had to take a group with me. So, but there's a lot of times when you get outside the international kind of waterways, they say, now you can start doing stuff. And so some people think that they wait to create revenues until they're in a place where they're not taxable. But cruise lines, yeah, essentially pay no tax. So their net income or EBT is essentially 1. There's no impact at all. So there are some definite industry impacts, but their tax impact should be about 1 minus their marginal tax rate. The interest impact, that's how much the interest is reducing their net income. So you can see with Walmart, it has been as high as 90%, but now it's back down to about 30%. And then their leverage started off about 2.5. Now they're up to 2.9. So they're more levered than they were. And that's going to increase their ROE for bad reasons. So you can see the return on equity right now is 13.9%. If you want to say what would their return on equity be if their financial leverage had not changed, then you could go back and take the starting number. You can see it's about the same. It didn't change that much. Why would the interest impact maybe have come down? Any guesses on that? What's been happening to interest rates over most of that time, ignoring 2022? Been declining most of the time, right? In the last few years, they jumped back up, but most of the time interest rates been falling. So you should see the interest impact being less. So, you know, here, very little interest impact. Why? Because interest rates were essentially 0 back then.
And if I have to leverage for this, like we went from like 2019 17.62 to 93.
All right. So this ratio can get really, really tricky if the firm's net worth just suddenly dropped. So line 25 is their net worth. Look on line 25 and see if their net worth had an unusual drop all at once. And why does that happen? Usually because they bought a lot of their stock back. So in that case, you're going to have a little bit of trick. You may have to leave the chart out and maybe just discuss the chart. So yeah, if they buy a lot of stock back, they're very, very levered now. They reduced their equity, but they still have all the debt they had before. That's gonna make their ROE look wonderful, but it's really just a very risky. Yeah, you can almost not even show the chart. It's just, yeah, that's frustrating with these firms buying so much of their stock back. You can get those wild charts. So if that happens, you'll probably you can put the chart in and say, obviously this chart is distorted, but their net worth, you'll just have to explain it. But definitely their ROE is not higher because they're doing a great job. Their ROE is higher because they bought all the stock back and juiced it up. So then your focus is on, did the asset turnover times margin improve? Because so it's possible they had some benefit from that. But if that went up 2%, but the leverage made it go up 600%, most of that ROE change is because they added debt. Yeah. So you get a good breakdown from here. You can see where the different pieces are. So their ROE has been declining. It used to be 19%, and now it's only 13%. And the bad news is their combined financial leverage is up. So the good stuff is down. Asset turnover times margin is down. The risky stuff, the debt, is up. So the ROE is even really worse than what it looks here because it's a little bit levered up with debt. Oh, I'm trying not to hit escape. So if we look at this, this is the overall summary. Turn to return on equity. So we already said margin is the key. So now all we got to do is say is what are they doing with this leveraging up? So they've been consistently in line with the industry on return on equity. It's been volatile. You see the COVID impact. You can see the industry is kind of all over the place. No telling what's going on here. Although, you know, to Alex's point, I think the reason industry shot up, and you can see it in this line, the reason industry shot up is not because it became more profitable, but because it became more levered. And that was probably the industry. This is an industry that's been buying a lot of stock back as well. And so that caused the huge jump. So essentially what you're trying to say is this bad news for Walmart that they're flat and the industry jumped up? Well, the industry jumped up for bad reasons, so that's not bad. And Walmart has been flat, but their leverage dropped. All right, so essentially what you got to do, and this is one of the toughest questions of all. If I were you, in fact, let me do it with Walmart. So on this question, I think I would create a blank sheet and I would bring in all the important pieces here. So asset turnover is an important piece. Net margin is an important piece, if I can find it. The tax impact might be, I don't know if I gave you all the tax, and I didn't give you all the tax impact. It may be on, yeah, it's probably on page 2. I think I gave it to you just in case. So it's possible some of y'all have noise related to the tax impact, so I put it in there just in case. You don't need to talk about it in the paper. And then the financial leverage. And so asset turnover has been strong and has improved the last few years. So you might look at each one and say, okay, so all of these are going to feed into the return on equity. Oh, I didn't bring in the financial leverage. Let me find the financial leverage. So all of these charts are going to feed into the return on equity. So what you essentially want to do is look at each chart and get the overall stories. So asset turnover has been flat, but it's been strong. Margins has been declining. The tax impact is pretty flat. Combined leverage has been pretty flat, although it's declined the last couple of years. One thing that could help you with this is to take out anything that's not the industry median. So take out the 90 on each one of these. So you can see the, you can see the charts better. So you can, it's not, the tax impact is not having a big impact. The financial leverage is causing a little bit of noise, but nothing major. So the overall decline over time is really a combination of the slow decline of margins over time and some volatility from the leverage. Remember, the volatility from the leverage because they borrowed a lot of money to buy Flipkart. So that caused a little bit of noise. So for Walmart, the bottom line in here is volatility from leverage, declining margins. That's the bottom line story for them. This is tough though, because you can get one ratio is doing this, one ratio is doing that. This one's helping, this one's hurting, and you have to kind of figure out the different combinations. This is the part you probably want to meet with me just on the ROE part, because I think almost all of y'all are going to struggle with it. It's the hardest part because there's so many moving parts. It really is tough to get the story. But don't talk about the ROE until you've got a story on turnover, margin, and leverage. Find some way to put in words each one of these, and then go look at the ROE chart and see if you can figure out. So like with Alex, your ROE chart's almost useless because of that massive amount. But you can still tell the story. What is your turnover telling you? What is your margin telling you? That's where you want that final conclusion. So for Walmart, I say Walmart is consistently strong on turnover. They struggled a little bit, but have come back here recently and are still leading the industry while the industry's been selling off. However, Walmart is really struggling on margin. It has been flat the last few years, but definitely well below where they were 10 years ago. On leverage, it's volatile because of the Flipkart purchase. And so is the industry. But overall, Walmart is losing ground because of the declining margins. That's where I'd focus my energies. That's the kind of conclusion you're trying to get to. And then what do you really want to do? You want to get something great to quote from your business breakdown podcast, especially for this part of the paper. All right. I can't show you that because they haven't done Walmart yet on business breakdown. I hope they do one of these days. So,
Want a quote from our business breakdown about their ROE?
well, I think all of you are going to have something on turnover, something on margin, and then try to find something at the end on the overall return on equity. You may not have a quote on return on equity, but you might have a great quote on margins that you could put in margins, but you might put it in your overall final conclusion. You might say, I think margins are the biggest issue as we heard in the business breakdown, blah, 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 and it just fits really, really well there. Some of you on your business breakdown, they will talk working capital, talking about inventories especially. So listen for that. You know, AutoZone is the one I gave you example on that, which was really, really powerful. But listen for that, those type of quotes. I doubt you're going to have much on solvency. I don't remember them talking much about use of debt in most of these podcasts. So definitely turnover, definitely margin, maybe working capital, and you want to bring those quotes in. Now, I'm hoping when you listen to the business breakdown the second time, it's going to sound a lot different. You're going to be hearing things more as a finance person than just general listening to a podcast. All right. So for Walmart, of all the issues above, margin is where I'll focus my attention. How can they attract customers who have to cut prices and harm margins? High inflation of 2022 is probably having an impact. It's important to assess Walmart success, a key strategy, online, overseas expansion, curbside. I've made these stuff up. I don't know if those are really things they're doing. But those are the things I would definitely focus in on if I were Walmart CEO with that massive apparatus that they have. All right, so that's the entire paper. So you have liquidity, solvency, and turnover done. So this weekend you'll have a first draft of the entire thing. I was going to meet with Emilio, but if you email me on Canvas, it goes into my spam folder for some reason. And I checked when I got him. I finally saw Emilio's. I looked at my spam folder, like 400 things in my spam folder. But I did find a few of y'all's. I don't go on the Canvas as much because it's hard for me to log into Canvas on my iPhone. So I don't. So your best, if you're gonna, you can email me in Canvas, but you might follow it up with an email to my email account to make sure I see. But I'm assuming I'm going to start seeing a lot of y'all on Zoom this week and next week as you try to finalize this thing up. But now will be a good time to go back to the business breakdown and listen to that one last time. I would wait until you get your final draft and then go back and start listening. There is a way to get the transcript of it. I can't remember how to do that, but if you go into Colossus, they'll show you. Yeah, I think you have to go into Colossus. I don't know if you go into Apple, it works as well. But if you go into the Colossus network, there's a transcript, and that may be the best way to do it. Then you can just copy and paste the quotes over. Everybody comfortable with what you need to do? All right. So everybody understand what the first exam is going to be?
It's going to be basically this again.
I'm going to give you a blank page, but all it's going to have are the graphs. I'm going to give you a printout of print page 1, so you'll have that. I might give you well, I probably won't give you a printout of graphs because that's really tough with all the color, but I'll give you a printout of print page 1. So it'll be a Word document, but the only thing in the Word document is going to be the graphs in order. So you don't have to worry about what goes where. You can have your Word document open for your company. It's going to be different what company I give you. But if you're trying to remember what to say and what to look for, you'll at least have that. I wouldn't over rely on that. I would study for it as if it's closed books because we're going to be somewhat time constrained. And if you're going back and trying to look at your company completely fresh, it's probably not going to be good. All right. And y'all remember what's the one place where students forget to write?
There,
Growth and revenue, right? Because there's no chart on growth and revenue. So make sure you have that one discussed. Could you copy and paste from your paper over? You could. I wouldn't do that just in total, because that could really throw you off. But you certainly could. Some students, especially on the turnover versus capacity, some students like to copy that over and just edit it a little bit. It might work. It depends on what company I give you. I'm not going to give you any of your companies, obviously. So I'll give you another company is, a different type of company.
and is this exam going to be in class or is it?
It'd be in class. I'll talk to the professor beforehand so we can try to start early. How many of you have a class afterwards? Right afterwards. So yeah, you're gonna be time constrained. So you're gonna have to really get here on time really early. I'm gonna try to start 10 minutes early. So that's part of it. You got to move. So if you know it, you won't have any trouble finishing. If you didn't study for it, you're just relying on looking at your paper, you're probably not going to finish, and that's going to crush you. So you really need to study for it as if it's closed book. So you're prepared for it. And you should know this stuff anyway, because it's pretty critical stuff. All right, I don't remember what an exam is, but it's a couple of weeks. I will have your paper graded before the exam, and I'll tell you if you had some massive error in your paper that you want to watch out for the exam. So that's one of the reasons I spaced the two so I could get the paper back to you. It's tough for me grading your first paper because I actually give you comments, and it's really hard for me to get detailed comments for a class this size, but I'll do my best. There will be a lot of typos, so you'll have to try to guess. All right, so we're going to leave this. I'm going to start talking time value money. So we're going to do time value money. You probably already have done time value money. We're going to do it again. We're going to get you your accounting or finance major or an actuarial science major. You should be able to do this better than anybody on the planet. It's just be second nature. When you hear a number and you hear an equation or an assignment, it's just your mind knows exactly what to do. That doesn't mean you can plug it into a calculator. So we don't want to learn calculators. Calculators are a waste because you won't use them. You can plug stuff into Excel formulas, but the problem is then Excel's doing all the work. It becomes kind of black box. So what you're going to see in the applications, I'm going to start getting those applications out to you. I'm kind of waiting to get paper one done first. Is you have videos you show how to do stuff in Excel. When I do things in Excel, I build it out in details so I can see exactly what Excel is doing. So I don't want to just plug things into formulas. You can do that and check your work, but you're better off learning exactly what Excel is doing. So let's get into this. This is powerful stuff. I have a lot of students that the Excels they build in this part of the class, they keep using after they leave the class because it's really, really valuable stuff. So time value money, we'd rather have $1 today than $1 in the future. Why? Well, we generally think inflation is a positive number. It's not always. In the Great Depression, we actually had negative 15% inflation. So you can't have deflation. But generally, we think something's going to cost more in the future than it does today. So we'd rather have the dollar today. It can buy us more stuff. The second thing is kind of the risk-free opportunity. If we have $1 today, I could buy a treasury bond and make interest. If I get the dollar in the future, I miss out on that. So that's kind of the risk-free opportunity. It's just interest rates. I say interest rates are almost always positive. They actually had negative interest rates in the Europe area, which is really bizarre. Why would someone invest $1,000 that's going to mature at $990? Well, if you're an individual, you wouldn't, because you could stick that money in under your mattress and it just stays $1,000. But if you're a massive global corporation, you can't stick money under the mattress. So you might actually be willing to take a negative 0.2% return just to park your cash somewhere so it doesn't get destroyed. So, but generally interest rates are positive. So you can invest today with no risk. You know you can get your money in the future with more money. Why would you take $100 a year from now if you get $100 a day invested at 2% and have $102 a year from now? The other reason is risk. If I have the money today, it's sure. If I'm gonna get the money $100 a year from now, the person may not be around to give me the money. So there's that risk that kind of, if someone says, I'll give you $100 a day, or a year from now, you're like, well, I see you today, give it to me today. That's a lot less risky. And then the last thing is just human nature. We prefer to spend than save. And so for us to say, we have to be induced to save. Someone says, hey, I'll give you $100 a day or $100 in the future. So give me today, I'm going to spend it. And say, well, what if I give you 105 in the future? And say, okay, I'll delay my purchase. So we'd rather have jet skis today than $1,000 a year from now, but we might rather have $1,500 a year from now than jet skis. So that's human nature. That changes over time. That inducement to save. So in 2020, that inducement was really low. People didn't need much to induce them to save. Interest rates were really, really low. Today it's much higher. So that changes over time. This last piece is essentially captured in all these others. And inflation is actually captured in these. So we're going to ignore inflation. We're going to ignore human nature because the opportunity cost considers inflation. If inflation is 2%, the federal government may pay you 3%. Inflation 6%, the federal government's going to pay you 8%. So inflation's already embedded in what the government's paying you. And the same thing with risk and those type of factors. I mean, it's all captured in there. If people prefer to spend than save, then you have to offer them higher returns to induce them to spend. And it changes by culture too. I don't know what the savings rate in the United States is. Anybody know? Well, they give that number. They used to report it. Personal savings, 4.1%. You need to save how much for retirement? Probably around 15%, but 4.1%. And that gets a little tricky. Does that include 401k plans? That include pension plan contributions? I saw an article that in China, that number is 35%. Why did they say 35% in China and 4% in the United States? My insurance class talks about it here. When you have insurance, auto insurance, life insurance, health insurance, you don't have to save as much because the insurance bails you out. If you don't have insurance, especially health insurance, you have to stick a lot of money to the side just in case something bad happens. So insurance helps people spend more and not have to save as much. But yeah, it changes by country. This number has been really, really low. It actually got almost down to 0. So it's actually recovered somewhat in the United States. But that's the human nature side, and it varies by country. We had a while there where the US consumers were spending and not saving, and Chinese consumers were saving and not spending. And everybody's like, what happens if one of those groups changes their mind? And it was like this complete disaster. If the Chinese consumers started spending and not savings, the US interest rates were just going to go through the roof. If US consumers suddenly started saving, not spending, we have a big recession. So we had these two different countries that were essentially balancing each other off. But we're kind of switching places now. So this is what DCF is all about. It's the most important part of finance. It's what we do the most, the discounted cash flows. And we have concepts of present value and concepts of future value. Present value is you're trying to figure out the price of something today given some future cash flows. That's what we're going to do when we value bonds and stocks. If you buy a bond, you promise these future cash flows. You just want to know how much should I pay for the bond today. If you're going to buy a stock, you get these future dividends over the next several hundred years, whatever. How much would I be willing to pay for that today? All right, that's present value. We're going to do almost entirely present value problems. I'll give you some future value, but not much. Future value is when you're saving for something in the future, like your retirement. How much do I need when I turn 70? That's a future value problem. I'm going to show you a really cool spreadsheet that you can use if you like to do your retirement planning. That's a future value problem. But those are the two ways you'll see it. But present value is the most common. You're doing your cost benefit analysis for your team project. That's a present value problem. Valuing stocks and bonds is a present value problem. So a lot of what we do in finance is a present value problem. And wealth management is mainly future value problems. Right, so a present value, I don't know why I started with future value. So a present value is if you're going to get $104 in the future and you want to know what it's worth today, you're going to divide by 1 plus an interest rate. Future value is you have $100 today, you want to know what it's going to be worth in the future, you do times. All right, so future value is times, because you have money today, you want to know what it's going to be worth in the future. Present value, divide. You know what something is in the future, you want to know what it's worth today. So it's a present value. Have y'all done formulas like this in your accounting class? I look a little familiar. Did you do it on your calculators or in Excel?
I think mine was in money in banking. when I did my
Oh, money in
final
banking. Okay, that's interesting. I didn't know y'all had money in banking yet. Have y'all had money in banking?
revision. I'm at it right now.
In it right now, and I thought you had this class to do money in banking. All right, that's interesting. All right, so that's all well and good. You can, if you have multiple cash flows, then one comes in year one, so you divide by 1.04, but then you raise it to 1 year. You get $100 in year two, so you raise it to 2 years. So the N is how many years out into the future, and you get the present value. We'll do this in Excel some. On future value, it's a little bit different. It's you have a cash flow that you're going to have. You're going to get it in 1 year, but you're going to invest it for 3 years. So you have it for 2 years. You get another cash flow a year later. You have it for in 1 year, and you get $50 right at the end. So you get it for 0 times. So that's just worth $50. So you see the future value is $262. The present value is $233. The present value is a smaller number. The future value is a bigger number. All right. But that's not the interesting part. The interesting part is when we have multiple cash flows. Let's jump to the annuity. So an annuity is when you have a cash flow that just goes off into the future. The same dollar amount. You have a lot of applications of that. Bonds somewhat do that. You get the same interest payment every year. Stocks, we're essentially saying we get the same cash flow every year. And you can't even have an annuity that goes on for eternity. That's called a perpetual annuity or perpetuities. The value of a perpetual annuity is whatever that cash flow is divided by the discount rate. So if someone says, I'll give you $1,000 every year for eternity, and your discount rate's 5%, how much would you pay for that today? You'd pay $20,000 for that today. All right, so let's try this. Let's do a little bit in Excel. We're gonna be doing quite a bit of this with some practice. So let's put time, let's put the cash flow, let's put the discounted cash flow. So let's say time is 1 year. Y'all don't need to write all this down. Let's go, I don't know, a few thousand years. Now you might say, how can something be worth something today if it's eternity? Because I won't be around for it. But it still works because when the person dies, that goes to their estate and it's still valuable to someone else. So it still has value. So I can give you $1,000 for all of eternity. I'm not doing eternity, but 2,773 years is good enough. What's my discount rate? Let's say it's 4%. What did I use in the example? I can't remember. 5%. Someone used 5%. So what's my present value? So the present value is the cash flow divided by 1 plus the rate raised to the time. All right, so that formula, you should be really, really comfortable with that formula. So here my cash flow is $1,000. What's my rate? 5%. Y'all know how to lock it in. Y'all learned that, how to lock the formula. It's your F4 function. What, I don't know what it is on the Mac. I think it might be Control F4.
F and C.
Huh?
It's the F and
If,
Just
yeah,
and then 4.
so you want the dollar signs there. Why? Because we always want that to be B3. If you don't do that, it's going to keep moving it down. And what's my N here? It's 1 year. Don't need to lock anything there. So what's $1,000 a year from now worth today? If you use a 5% discount rate and it's worth $952.38, we can copy that down. So what is the present value? The present value equals the sum of each cash flow present value. So in this case, equals sum. And guess what we get? 20,000. What did I say is the other one? Present value equals the cash flow divided by the rate. $1,000 divided by 5%. It's worth $20,000. Which one's easier? To do 2,700 lines or to do 2 numbers? Much easier this way. So there are these shorthand formulas that we can use and save us a lot of time. Now, what if they say, you know what? I'm going to pay $1,000 a year, but it's going to grow at 1%. Is that going to change the value any? It's going to be more valuable, isn't it? So now how much is this going to be worth? Any guesses? You start with $1,000. At the end, you have whatever that number is. They're going to pay that every year. What's the value? That looks like a huge number, doesn't it? Y'all, anybody notice anything about the present value of that? Why is it 0?
Because
you're so far out into the future. Even though it's a massive number, the present value of that today is essentially 0. So what is this value? You notice it's a round number. How do you think I got that $25,000? What would I do to this formula to get $25,000? I wouldn't divide by 5%, would I? I would divide by what? The discount rate minus the growth rate. That's how we value a stock. We assume it pays $100 this year, but growing at 5% and a discount rate. That's how we're going to value the stock. This is called a perpetual growth annuity. And its value is the cash flow, the first cash flow divided by the rate minus the growth. In our first example with 20,000, my growth rate was 0. So we just took 1,000 divided by 5% because growth was 0. But as the growth rate goes up, what happens to the value of this cash flow? It's going to keep going higher and higher. What happens if the growth rate's 6%? What's going to be the present value? Well, you're going to have a disconnect. You're going to notice you get a negative number and you get a positive number. Which one's right? What are you noticing about the present values as we go through time? Remember back here when the growth rate was 2%, what are the present values doing? They're falling. What happens when growth rate 6%? How far in the future we have to go so that present value goes to 0? Never does. What's the value of this cash flow? How many years have to go out before the present value goes to 0? The present value of that is infinity. Right? Is you cannot have a growth rate that's higher than your discount rate. If someone shows you that, if someone says, hey, Google, here's Google's cash flow and their discount rate's 8% and their growth rate's 10%, it's that you would say, okay, Google's worth infinity. I'll pay you infinity. Are you going to pay infinity for Google? If you own Google and you sell it, say, hey, I think that's worth infinity. Is Google worth infinity? It's not. So what's wrong? Either your discount rate's too low or your growth rate's too high. You have to adjust those. All right. So a stock or any instrument cannot grow faster than the discount rate because it's worth infinity. This formula doesn't get it right. This formula gives you a negative number because this formula doesn't know how to handle growth rates that are higher than discount rates. The formula just messes up. And I've had students own papers, can you believe this? Have a discount rate that's lower than growth rate. They will actually put, I think Apple's worth negative $432. And they'd write it with a straight face. I was like, obviously that's wrong. If I own Apple stock, I'm not going to give it to you and pay you $400. That's not going to do. I might give you the stock. I think it's worthless, but I'm not going to pay you $400. But they put that in their paper. So obviously this formula only works if the discount rate is greater than the growth rate. All right. So what can we do with this? Well, we can do all kinds of things. So what you're going to see, our application here. So present value, we're going to do things like a loan. You can get some practice on doing car loans. That's a present value function. We're going to value bonds. We're going to value stocks. We're going to do cost benefit analysis, which is your group project. So we have a lot of present value functions. Your Excel applications, the first 4 or 5 or 6, well, probably the first 7 of them are present value problems. You have several that are this. You have one that's that. You have a couple that are that, and you have a couple that are this. On future value, we're only going to do one thing with future value, and that's a retirement planning. That's about all we can do there. We're not going to do a whole lot with future value. Future value is really, really important for wealth managers because essentially they say when you turn 65, you need $2 million to retire. How are we going to get you to that 2 million? So we're going to help them know how to save and get to that 2 million, but that's the only application. So finance is really front end loaded on this. We're going to actually do it. I don't have it in the right order here. We're going to actually do the loan side first, then cost benefit analysis, then value bonds, then value stocks. We're going to do it in that order. So you'll get quite a bit of practice. You're going to do it in Excel. And what you'll notice in Excel, we have this function, which is a present value function. When you have multiple cash flows, you don't need to memorize this formula. Your calculator has this formula, Excel has this formula. We're actually going to type this formula out in Excel, and you'll see that in applications. So it's not a difficult formula. And when we do bonds, I'm actually going to show you that the formula is actually pretty straightforward. It's a pretty easy formula. It doesn't look like it on the surface, but it's pretty easy. Same thing on the future value. So we have a future value. We have, like you're saving for retirement, you're going to save $1,000 a month for retirement. We'll use this future value problem. It's an easier formula. I don't know where the formula is. I had it somewhere. Yeah, somewhere there's a future value formula, but that's the formula. We're going to put that into Excel as well. And we're actually going to put them both in there. So you have the present value and the future value. Then you have to decide which factor you need. So you have both factors and you have to ask the question, is this a present value function or a future value? Same thing when exam 2. I'm going to give you a problem. You got to figure out, I'm going to give you these formulas. So all you have to do is plug the numbers in. All right. So what we'll talk next class is how do we know which rate to use and which time to use? What if we're doing things monthly? What if we're doing things weekly? What if we're doing things daily or annually? So we'll have to figure that out. All right, so we'll start there next class. Quick introduction today, but we'll definitely be getting into it. They've done a good job of keeping their revenue square foot below 250. Does that sound right? Do you want this number higher or lower? Higher. And is there any benchmark of 250? Because actually it's 250,000. So, or maybe it's 250 square foot. So that one doesn't make sense. Revenue per square foot is a measure of what? In our template, remember liquidity, solvency, turnover, and margin, revenue square foot. Turnover. It's a turnover ratio, right? So margin doesn't make sense. They have been very stable, but falling behind Raleigh since 2015. How does that sound? That sounds pretty good. Revenue per square foot is a measure of solvency, not a measure of solvency. Where could it be tricky? Remember, there's a close tie between liquidity and turnover. You could maybe make an argument, but definitely turnover makes the most sense on that one. So
Okay.
So that one is C. Honeywell, they have both been industry's leaders. That's certainly true here recently. So maybe that's it. You might disagree with it here, but if they're above the median, I think you can make the argument. Revenue per employee is a key measure of gross margins. What is revenue per employee? Anytime you see revenue per, what is it going to be? Turnover, right? Turnover is revenue divided by something. So that doesn't make sense. Honeywell has been more consistent. Does that look more consistent? But 3M is just showing the strongest improvements. That one's right if you just switch the names. So it's just backwards. Revenue per employee is a good measure of liquidity. That one is on the cusp because there is a relationship between that, but it's much better to call it a turnover ratio. So yeah, probably A on that one. Yeah. All right. So then the hard one to read. So which of these is capacity? Which of them are turnover? Number of stores is what? Capacity, revenue per store, turnover. Which one do you want to be really excelling? Revenue per store. All right. They've seen a decrease in capacity. That's not true. They've seen a decrease in capacity. That's not true. They've seen a decrease in turnover. That's true. They've seen a decrease in turnover. C and D are correct as far as what they're calling what. So turnover is done, what is down, capacity is up. Is that good management or poor management? Yeah. If it had been the exact other way, you would say pretty good. They closed down some bad stores, and the stores they've had have had some really good growth. But yeah, that looks like D is the right answer there. How are y'all doing? Anybody 100% so far? Okay. All right. It's possible, but I'm not going to count it. So
Wow.
it's on the edge. But all right, Deere, one of my more interesting firms. All right, so price markup, what should your margin be? If you have a higher price market, your margin should be what? Should be higher. All right, because the gross margin is just revenue minus cost of goods sold. So if your markup's higher, you're gonna have a higher gross margin. So they have a smaller price mark. No, they have a higher price markup. Their sales minus cost of goods sold, which is what gross margin is stronger and more stable. Does that sound good?
Yes.
It's stronger and looks a lot more stable. Higher fixed costs and variable costs. You can't say anything about fixed and variable costs from gross margin. Maybe from net margin, but not from gross margin. All right, so that one doesn't work. So it looks like B would be the right answer there. I think I saw a lot of B's on that one. Y'all turn them in. Okay, what can conclude about Caterpillar? Smaller price markup. You can't tell that on net margin. That's the gross margin because there's so many things between gross and net margin. They have higher fixed costs. All right, so this one, a little tricky. My argument is if you have higher fixed costs, your net margins can be more volatile. I don't think you can tell which one's more volatile between these two. Maybe Caterpillar is a little higher, and maybe you could argue they have a higher fixed costs, but I think it's a little questionable. But that one is possible just if you argue that. Definitely you can't say higher variable costs because if anything, Caterpillar is a little more volatile than them. They have been consistently less profitable. So lower net margin, or another way to say that is less profitable, right? So net margin and profitability go together. So yeah, they have been lower until a major improvement in 2018. So that D looks pretty good on that one. Hopefully I get the right answer here. All right, and then the tricky one, this one's a little tricky. So which would you rather be higher on, 14 or 16? 14, that's the good news. 16 is the bad news. So they're worse on 14, which is bad, but they're lower on 16, so that's good. So it's kind of a mixed bag here. The return on equity is much lower, just do almost exclusively. Now, if I said mainly, you could kind of say, yeah, a bigger gap here than there, but it said almost exclusively. There's a gap there, so you can't say exclusively. The return on equity is much lower, just almost exclusively. The lower, no, that's not true. So you can't say exclusively because they're both bringing their ROE down. Has been much weaker due to both weakness in turnover and a much more aggressive, no, this not more aggressive financial leverage, it's less aggressive. So it looks like D is the only answer left. It's a mix of weakness, that's weaker, right? They're lower on ATO times margin, weakness there, but strength here and being more conservative. So D sounds good on that one. And D, all right. Yeah, it's some of this. Group one. Wow, group one only missed one. So we see who's group one. All right, so you only missed one, and that's the one you're debating me on, right?
Number two.
Yeah, no, I can't guarantee. All right, we'll see. We have a lot more of these, you know, in the second part of class, we do a lot more of these out of the exam to practice. So I'll put this out there, if I remember, on Canvas. I was gonna say LinkedIn, but I won't put it on LinkedIn. All right, so now we're getting into probably the most practical part. This is something you've got to know. So hopefully you read the notes. We're going to learn this part of it in Excel rather than in the notes. It just Excel is the place to be. There's really 4 formulas you need for exam 2, and really for the fact exam, these are the formulas that you need. So the first one says something today, its value today is some future value divided by, when you do a present value, you divide the future value by 1 plus I to the n. The future value, the value sometime in the future, is equal to some value today times 1 plus the rate to the n. All right. The next equation you need is the present value equals some payment times the present value factor. We'll use this a lot when we're coming up with financial, come up with an amortization schedule for our loan. So we know what the car costs today. We just don't know how much our monthly payment is going to be. Or we know what our monthly payment is, we can afford, how much car can we buy? It can be either one of those. All right. And the last one is the future value is some investment we make on a regular basis times that factor, future value factor. This we'll use for like retirement planning. We might say, hey, I need 2 million. In fact, I'm going to show you a retirement Excel model maybe today. If we get, I think we'll get to it today. So I need $2 million when I retire. Here's my factor. How much do you need to invest every month to get there? All right. The only one of these that we probably won't use a whole lot of is the second one. We don't do the second one too much. I'm sorry, the first one we won't use too much. The second one we'll use quite a bit. The first one we won't use much. And I'll talk about, in fact, you'll have one of your Excel applications will do that one. All right, so let's just practice this so we can get some practice with it. So what you're going to do when you do Excel applications, you'll see it, the video shows you how to do it. You want to put these 2 long formulas. I'm not making you memorize these formulas. You just have to know how to use them. So you want to put them into Excel. So you're going to have a rate, you're going to have time, and you're going to have probably some target you're after. All right. So let's say you're going to buy a Tesla and make monthly payments for 5 years. Right. The bank charges 4.8%. Right, so we're going to start with this first problem. I'll show you how Excel does it. I don't use the Excel functions, so I actually want you to build it. And when you do the Excel applications, you have to build the entire thing. I like using Excel to learn finance because the formulas are like these black boxes. You don't know what the formula is doing. I want you to see what the math actually is so you have a better understanding of what's going on. So here's really, really critical. I don't know how to get this in your notes. It's in the class notes. The interest rate is the rate for the period of time you're doing. So the rate here is 4.8%, but you're not paying the loan off once a year. When are you paying it off? Once a month. So how many payments do you have in a year? 12. So your rate is going to be your annual rate divided by how many payments you're going to make in a year. If you're making weekly payments, what would you divide by? 52 or whatever, 52 point whatever, you know, it's not exactly. All right, so your rate is going to be the rate for the time period you're doing it. So you take the annual rate and divide by the number of periods. Your only choices I'm going to give you is going to be monthly or weekly. So if it's monthly, divide by 12. If it's weekly, divide by 52. So that's going to be your rate on a monthly basis. And time's going to be the same thing. They said this is a 5-year loan, but how many payments are you going to make?
12 times 5.
12 times 5, right? Your time is number of months. Your rate is rate per month. Okay, so if you do that, it all works out very, very well. It's really, really critical. So make sure you're really comfortable with that. Now, what's my target? How much does a Tesla cost? I have no idea. I would never buy a
I think it's
Tesla.
like 45 grand right now.
Not the cheap one, but the good one.
Oh.
60,000 maybe?
60, upwards of 60.
So let's say 60,000. I've got a Prius. I got a cheap. Mine's only 23,000. All right, so we need the factor, present value interest factor, and the future value interest factor. So this a formula you don't have to memorize, but you will have to get it into Excel. So this is a practice in getting your parentheses in the right ways. So you do 1 minus 1 divided by 2 parentheses, 1 plus your rate, close parentheses, raised to your time, 2 parentheses, minus 1. Now, on present value, the factor will always be less than your end. On future value, your factor will always be greater than your end. Okay. So here it's got to be 70 or something like that. Oops, I have a math error. Oh, there's no minus 1. Why did I do the minus 1? It's, oh, I'm sorry, divided by the rate. Why did I do that? So I knew it was wrong because it's a negative number, but 53 looks about right. I went the wrong direction. 53 looks about right. So present value 60 is going to be a lower number. Future value, so future value might be 70. So the present value interest factor is 53. We normally go out 4 decimal places, and that has to do with rounding. Since in the US we go out 2 decimals on our dollars. So when you're doing dollars, if you go out 4 decimals on present value interest factor, you're not going to have a rounding problem. Usually between you may be off a penny, but it won't be huge, right? And any of y'all get that in your Excel?
Yeah.
Right.
I got it.
All right. Now the future value is a much easier formula. Equal 2 parentheses 1 plus your rate raised to your time divided by your rate. I can't see the rest of it. I don't know why I want to keep doing minus 1. I keep seeing the minus 1. That's still not right. So what did I do wrong? Oh, the minus 1 goes before you divide by the rate. So I get 67, 66. Does that look right? It looks about right? It's about the same distance as the present value one is. So future value is going to be longer term because you're making money. You're adding to your interest. Present value is going to be a smaller number because the value today is going to be smaller than that future value. All right. So once you get this set up, the nice thing is you can keep copying this over for all other problems. And then all you have to do is change your rate and your time. So you get those formulas set up once. I used to be to fly through these formulas on the calculator, but I get the 2 of them mixed up where you can subtract the 1, but you don't need to memorize these formulas. There's really no value to doing that. Your calculator does that as well. So your calculator has this, and the calculator essentially is doing this math as well. But I want you to see the full picture. Any questions up to there?
Could you just go to, over the B4, please?
On exam 2, I'll let you use Excel on the exam. You can check your work using the Excel functions, but that's not your answer. You have to do it exactly how I'm doing it here because I want to see the whole thing, but you can check your work. Same thing on the bond valuation. Excel will do the bond valuation. You can check your work, but I still want to see the table. I want you to see exactly what the math is. All right, so here's what we're going to see when we do an amortization question. You're going to start off with time. I'm going to put that in row 8. You're going to have a beginning balance. You're going to have your interest expense. Now on the video, I might switch these 2 columns. It doesn't matter which order you put them in. Then you have your payment. Then you have your ending balance. And you're going to see when we do a future value problem, it looks almost exactly the same as this. Except for instead of interest expense, it's going to be interest earnings because you're making money. Instead of payment, it's going to be an investment, but the columns are going to be exactly the same. All right, so how many months do we have? We start with month 1.
Yeah.
And you take equal that plus 1. You're going to have 1 plus 1, and you're going to keep doing that down for, and you want to get down to 60 months. How do I get to the bottom?
Control,
Shift down.
shift, yeah.
I do control down. You don't want to do shift because shift's going to highlight them, and I don't want them highlighted. So control down. So go down, you have 60 months, control up, control down. So you want to have 60 months in there. All right, this is a loan, so what is my beginning balance? How much do I owe at the beginning of time 1? Here it's 60,000, all right? A future value problem will start with 0. Here we start with 60,000. What is my interest expense? Well, my interest expense is that beginning balance times my rate. And I want to lock that in. Y'all remember what lock in means? Because we always want to reference back to that 0.4%. You don't want to change this. If you're not getting this, you're going to see a video that does the exact same thing. So I just want y'all to get really, really good at that. So your interest expense is the beginning balance. Why is that? Because these present value factors assume this first payment happens at the end of the month, not the beginning of the month. That way you owe interest for the entire month. If you made the payment at the beginning of the month, you'd only owe interest on the 60,000 minus that payment. But since you didn't make the payment until the end of the month, you owe interest on the entire beginning balance. That's $240. And then what is the payment? All right, so here's where we're going to use the function. The present value equals the payment times the present value interest factor of the annuity. What's my present value here? How much is the car worth? 60,000 equals the payment times the factor. What that means is the payment equals what? Payment's going to equal 60,000 divided by the present value interest factor annuity. All right, so you'll use that a lot. My payment is how much the car is worth minus that factor. That's going to tell me my monthly payment. So it's just good old algebra. So here on my payment, it'd be 60,000 divided by the present value interest factor annuity. So now some students get upset because I use the plus sign. You can use the plus sign or the equal sign. Anybody know why I use the plus sign and not the equal sign? Because the plus sign's right on the keyboard. That's equal sign's way over here. It takes me out like a half second longer. You must see that's not much, but when you're sitting at an Excel machine 10 hours a day, saving a half a second, a lot of times will get you home 30 minutes faster. So you start learning to do that. So here, the car costs 60,000. The present value interest factor is 53. There's my payment. That's going to be my payment every single time. That's not going to change. And then what is my ending balance? My ending balance is going to be beginning balance plus the interest expense minus my payment. Now, when we're doing a future value problem, we're just going to add all the way across because we invest and we make the interest. But on here, the interest is added because the bank's charging you the interest, but then they're going to subtract your payment. So we'll take that beginning balance plus the interest minus the payment. There's my ending balance. Anybody get 59,113? So why do we want this to be at month 60? We do it right. Should be 0, shouldn't it? You hope if you do it right. So what's my beginning balance at month 2? Yeah, your ending balance from the previous one. My interest expense, if you locked it in, you can copy that down. If you have B1, the 0.4% locked in, you can copy that down. What's the payment? Well, on the payment, you can just say equal that payment because that's not going to change. You just reference that. And then what's my ending balance? That you can just copy down.
Could you go back to C10?
So it's the same formula we had in C9. You just copy it down. C9 was B9 times B1. So C10 is going to be B10 times B1 because we have a different beginning balance. So my interest expense is going to fall, drop a little bit. My payment's going to stay the same. So you notice I couldn't copy row 1 down, but you can just copy row 2 down because everything's now set up. How do you copy it all the way down to the bottom? You might know how to do that. You can drag it, but you don't want to do that. Double click where?
Tiny square.
Yeah, the green square. So get in the habit of doing that. If you can drag, if you drag, I have a heart attack because I've seen some where we're going like 6,000, 7,000 rows. That can take you forever, and you're kind of like that. So I would do that. Just click on it. And what is Bill Gates doing? He's assuming you want to copy it until you have an empty row in column A. So just a lot faster. So I'm going to try to give you some Excel tricks. If you see me doing something where you know an Excel trick, you tell me. I'm an old dog, but I can learn new tricks. I learned without a mouse, which was really, really valuable. And then I've gotten addicted to the mouse since we got them. All right, so if I did this correctly, my very last cell should be 0. And sure enough, it's 0. Bill Gates says it's not exactly 0, but that's a problem Excel has. That's actually an error in Excel. So should be 0. Now on the exam, it may, well, we'll see. I can't remember exactly how I'll give you the, I think an exam, you don't have this problem. If instead of using this formula that we had here, if you didn't instead had actually typed 1126.78, you're going to have a rounding problem at the end because you're going to be off some fraction. Since I'm not using a rounded number, since this is actually out many, many decimal places, we won't have that rounding issue. Did anyone get all this set up?
Yeah, I got it all set up. I accidentally went like way past my payments to zero. Now it's a good way to delete a bunch of like extra cells.
Well, if you went too far, you just have to, you click on the first one, and this is where the control and the end shift, control shift down right. You just highlight, hit the delete key, and it's out of there. Yeah, get really used to, so Excel, many of your jobs are going to involve Excel. Excel, you want to become an expert at Excel. And you actually set up your spreadsheet to save you time. So I see students doing things like this. You know, they want it real pretty, so they want a little extra separation here. That is a huge mistake, because now I want to highlight this, and now it just creates extra ones. So having extra space, you want to set it up so you can use that control shift to control. You want to get around the spreadsheet as fast as possible. So you just want to, well, they didn't let me do it there. And that's because my titles, I messed up my titles, but you know, you want to get it so you can get around the spreadsheet quickly. So you want to get as fast as possible. You might say, well, it's only 10% faster, but you're going to do this stuff millions and millions of times. You want to get really, really fast. You also probably want to start learning some Visual Basic and some macros to speed things up as well. Anything you can do, cut time, do things faster, just gets you home faster, and also just makes you more impressive. Some of you, unfortunately, you're going to have a boss that doesn't know how to use Excel, and that's the reason they're hiring you. That's the boss you want to quit and go somewhere else, because you want your first boss to scare the life out of you because they know so much. But some of y'all will be in that camp. All right, let's do it again. So what we're going to do is I'm going to click up here. I'm going to do Control C. I'm going to create a new sheet. Hit enter, and when I do that, I have my formulas already there. So now all I got to do is just start from scratch. So I'm going to just start from scratch. So you'll do this when you do the Excel applications. You'll get the first one set up, and then you can just copy it and use it for the other ones. You just change it. So let's say we're going to buy a house. We're going to make bi-weekly payments over 15 years. And I don't know mortgage rates. I haven't looked at them in a while. Yeah, still don't see any. That's the 30-year, 716. Let's do 6.5. Bank charges. Oh, not 6.5. Let's do yeah, 6.5. Actually, I got one. So 6.5. All right, so what rate do I use here? Let y'all catch up with me. So what's the rate? It's 6.5%. We're not going to use that. Instead, we'll use what? I heard 6.5%. Divided by what? Not 12 here. It's bi-weekly. 26, yeah. Bi-weekly means every 2 weeks, not twice a week. It could mean twice a week, but every 2 weeks. Now I realize there's 52.178 weeks in a year, but 26 is close enough. Now banks will be absolutely precise because they do things on a day basis. So you won't, it'd be slightly different because they're extremely precise. All right, what's my time here then?
The 15 years times the biweekly.
times 26. So some students get mixed up where they'll multiply to 6.5 or they'll, so just be real careful. The rate is what would you pay every 2 weeks, 0.25%. And the time is how many biweeklies are there going to be in 15 years? How many payments are you going to actually make? And that's going to be 390. All right. Let's buy my mom's house. I've already sold it, but I'll sell it to you. I just looked up on Zillow. That house that's worth maybe $300,000 is currently selling for $515,000. So guess where her house is? There's no way her house is worth $515,000, but that's the current Zillow. I sold it for like $540,000, so it's the price has come down some. So she lived in Austin. She's now on a assisted living, but she had a house in South Austin, $515,000, just ridiculous, a horrible house. The realtor I work with, she said, yeah, this is not a very good house. It's got a really horrible entry, but they paid like $140,000 for it. All right, so there's my target, $515,000. Is that your true target? What else are you going to add to that? You got, you might have an appraisal to do, and the biggest scam of all time is title insurance. There's another 2-3% you have to add to that, but we'll ignore that for right now. You also have your down payments. I'm ignoring that, but some of the problems talk about the down payment. So all of that you'd have to be able to adjust. If you have a down payment, you would just subtract that out of the loan because they're only going to loan you that, but you're going to throw in all the escrow stuff in there as well. All right. So there's you notice here, it makes a big difference with time. So you have 390 bi-weeks you're going to make, but your factor is only 248. So as you go further out in time, the difference between your N or your time and your PV is going to get larger and larger because there's a huge impact of time. All right, so we're going to have 1 and 1, that plus 1, we're going to go that down 390. Now, and I don't know how to do this one any faster, but anyone knows that one's a little harder to figure out how to get that down. I don't know how to do it other than just copying it down, but 390. But again, use the control up and down. It was me. I don't know how it was me. I didn't touch anything. Are we on Zoom? I think I am, right? Yeah, I'm pretty sure. Yeah, right. I don't know why I got that. All right, what's my beginning balance? 15,000. Someone give me the formula for interest expense.
Rate times.
You want the rate, all right? Times what? Done the beginning balance, and then make sure you lock that rate in.
How do you lock it in again? What's the quick key?
I use F4. I think it's function 4 or something on a Mac. But you can just type it if you want to. So it is possible that you can just type the dollar signs in there. One thing I'll warn you about in Excel, some students like to use range names. If you use a range name, it's a huge hassle because if you take this and copy it to a new sheet, that range name stays. So I didn't want this referencing sheet 1. I wanted only in sheet 1, but sheet 2. But if I had named this beginning balance and multiplied by that, when I copied it from sheet 1 to sheet 2, it would still be referencing back to sheet 1. So I don't like range names. I don't recommend using them because they mess things up when you copy to another sheet. So you notice my interest expense is quite significant. That this is a mortgage. What's my payment going to be? Who wants to give me that?
Beginning balance plus interest expense minus your beginning balance.
Beginning balance is right. Your target.
Divided by
Divided by what?
Divided by P4.
The factor, yeah. So there's my mortgage. Now on the exam, look at that and say, does that look like a mortgage payment for a $500,000 house? It's a 15-year mortgage, not 30. Does 2,000 make sense?
Yeah.
My parents' mortgage in the seventies was, they got mad at me because I bought a new car. And the monthly payment was $270, and they're like, my dad's like, that's higher than our mortgage payment. Well, today your mortgage payment's $2,000, not $270, but that was like a $70,000 house they bought. All right, ending balance. Anybody remember that formula?
Plus beginning.
Beginning. And then what?
Minus
Minus payment. All right, so that should be declining. Beginning balance, you just bring that back, and then everything else you can just copy down. Well, payment, excuse me, you can copy interest down, payment, just reference, because that you want that fixed, and ending balance. And now you can just copy the whole thing down, and here you really want to click on this because we got a lot of rows there. And if I did it right, the very last one should be 0. It's pretty close to 0. Now, banks used to do something called the rule of 24. I hope it's illegal now, but I paid off my car loan early, and I knew exactly what I owed them because I had my amortization schedule, and they charged me an extra $200. And that's because the law allows them to use the rule of 24. The rule of 24 is an approximation of this, assuming there's no computers in existence. There were plenty of computers in existence. Why did I use the rule of 24? Because it let them charge me an extra $200. So hopefully that's not the case anymore. This should be exactly what you owe. If you make all your payments on schedule and you want to pay off the debt early, this should tell you exactly what you owe at any given time. All right, so the real key is make sure you understand the rate. The rate's the annual rate divided by the number of payments you're going to make in a year. Not by the number of payments, but the number of payments you make in a year. Be real careful how you type in. I've seen students do it 2 ways. I do 0.065. I highly recommend forever, anytime you see a percent, type it as a decimal, 0.065. You can type it as 6.5% divided by 26, but I don't like that. You're better off typing it as a decimal. Just convert it to a decimal, but it does work that way. And then the next one is years times number of payments within the year. As long as you do that, you shouldn't have any trouble getting the right answers. All right, I'm going to copy this over. Give me the example of what I meant. If I name this beginning balance, and then I take, so this cell is now called beginning balance. If I copy this whole thing to a new sheet, then it didn't do it. So anyway, I guess I just lied about Bill Gates. That used to be the case, but it's not anymore. So yeah, it's good. He must have changed his spreadsheet. So that's good. I take that back. If that's the case, that's kind of nice. Just be careful. It might have to do with the locking. I don't know. Let's see. You're going to notice it much more when you get to the cost benefit analysis ones. Yeah, it looks like maybe they changed their software. That would be wonderful if they had. All right, so I'm going to reset all of this.
Do you reset?
I just hit the delete key
Oh, okay.
and get rid of all of this. Actually, when you get rid of all this, you might just start
Yeah, you just.
after that. So you have your 2s. All right, so here we're going to do a new question. I need 2 million to retire at age 65. I am 22 today. I think I can make 6% my portfolio. All right, so and you're going to invest. I will invest monthly. All right, does this sound like a present value problem or a future value problem?
Future value?
Future value. So when you see loans and debt, that's usually a present value. If you see someone planning some type of retirement planning or something, that's a future value problem. There is one Excel application I'll give you That sounds like a present value, but it's really a future value, but you'll see when you get to that one. Right, they're gonna invest monthly. So what is my rate here? Same as before. We don't change it just because it's future value. So someone yelled it out. 6%.
Because you said you use the addition key because it's right there.
Yeah, yeah.
Are you talking about the numpad or?
Yeah, on the numpad, yeah.
Oh, yeah, numpad. So this one.
You got it? What I do? 6% what?
Well,
Oh, it's monthly. It's possible if you're doing this through a 401k plan, that it could be bi-weekly. USA paid us bi-weekly, but I'm gonna make it simple. What's my time here? 65 minus 22 times 12. Does that make sense? 65 minus 22, that's how many years you have to invest, 43 years, and you're going to invest monthly. So your time is going to be a really large number, 516 months. That sounds kind of depressing. You're going to be looking for 516 months. Are exciting, one or the other. What's my target here? 2 million. Expand this a little bit. All right, so beginning balance is good. Now it's not interest expense. You can call it investment earnings or interest earnings. I'm going to use interest earnings. And it's not a payment, it's an investment. All right. So my beginning balance is not 2 million, is it? What do I have today? You have 0. So what is my interest earnings? That's still the same formula, but I don't earn anything. Why? Because we assume everything happens at the end of the month. You start the month with 0 and you invest at the very end of the month. How much earnings did you have that month? None, because you gave them the money right at the end of the month. All right, so 0 there. What's my investment? Well, it's going to be here. We're going to say the future value equals your investment times the future value interest factor annuities. So here, your investment is going to equal your future value or the target divided by the future value interest factor annuity. So it's the exact same formula except for what? We're not going to use the present value factor. We're going to use the future value factor. And look how much bigger that number is than 516. We're going out 516 months. It's much, much larger, which is what you want, right? Because you're going to let your portfolio work for you. So you need to invest $825 a month. And then the ending balance, what do we do here? Here you just add all the way across because it's all your money. In fact, I recommend you never borrow money the rest of your life. So what I do with cars, I got one car that lasted a long, long, long time. And so after I paid off, well, I actually paid off that loan early, but what I started doing was making car payments, but to myself. And then every time my car went down, I just bought the car with cash. Why? Because I'm paying myself the interest rather than paying the bank the interest, which is kind of nice. All right, so there's my ending balance. There's my beginning balance. My interest earned is correct. My investment is correct. The only thing I need to do is bring this down so it's all added across. And here's where it gets real tricky. I've got to go down 516 rows, which is a lot. Close. 516. Does that look good? Yeah, $2 million worked out really, really well. Now, what's the chances you're going to have exactly 2 million in those many years? This is not going to happen. You might have 2.4 million. You may have 1.7 million. If 1.7 million is not enough, what are you going to do? You're going to be making adjustments as you go. The other big problem with this is what's the probability over your lifetime you're going to make the exact same investment every month? What are you likely to do? You're going to increase that as you age and as your salaries go up. So you're probably going to start. But you want to do what? You want to invest as much as you can to start off because that's going to have the biggest impact. That's the one that's earning as much as possible. Because what do you notice with the interest earnings? What do you notice about year month 140? Your interest earnings is greater than your investment. At some point, your portfolio is working harder than you are and is adding more to your portfolio.
You ever get weird, like, just pound symbols instead of your formulas? I can fix it. It's like,
Well, no, it's the column's not wide enough.
oh, okay.
Yeah.
Is that like, is there a term for that when the portfolio starts returning more than people think?
I don't know if there's a
When-
term. I haven't heard. Yeah, I'm not sure.
Doing really well.
140 months, so what's about 12 years in? I mean, it's pretty fast. The more you can invest early, the better off you are. And probably just put it all in stocks. I'm not in the camp that young people should be 90% stocks, 10% bonds. I just think that's a waste. Just go all in stocks and don't look at it every month, every week. Just invest and forget about it. If your firm has a 401k and they match, do as much matching as you can and just set it and don't even think about it. You're as young, the market sells off 30%. Who cares? In your 20s, you don't care. You're not going to notice that. Now, if the market sells off and we have a horrible stock market next 40 years, it really doesn't matter what you invest in because everything would have done horribly. You're just going to be poor the rest of your life. So, yeah, that scenario, well, once the US stock market does horribly, yeah, everything would have done horribly. That's unlikely to happen, but if it does, yeah, you'll just be working to your 80. All right, so that's a future value problem. On the applications, the first two I'll work for you. One's a present value, one's a future value, very similar to this. The other ones that I don't work for you, you have to figure out. One of them's really quite powerful because it asks, I've got a bank I'm going to go buy a car and the car dealership, they offer me a loan. And my credit union offers me a loan. The credit union has a lower rate than the auto dealer, but the auto dealer offers me cash back if I borrow from them. So I got to decide, is that cash back? Maybe they'll give me $1,500 cash back if I borrow from them, but they're charging me 6.5%. My credit union's only charging me 6.1%. You got to decide which is the better deal in those two. So you have to do that math and figure it out. So what are you going to look at? You're going to, in all cases, you're going to compare the payments. Some students make the mistake of summing up the interest expense and comparing that, but that doesn't make sense. It's the payments you're making.
So
The car dealership's you're gonna borrow 39,000 from them, but from the credit union, you're gonna borrow 40,000. You're interested in your total payments, not in your interest expense. So in all cases, when I'm saying compare these two things, your key is which one gives me lower payments over the life of the loan, not interest expense. Now, if the loan's the exact same amount, then yeah, the interest expense will tell you that. But if there's any difference in the loan, that won't work. So you're always best trying to compare two things, look at the total payments. Another one I'll tell you is I have this loan I'm paying monthly. What if instead of paying monthly, I pay twice a month? Again, you're going to add up the total payments, not the interest expenses. If you do that, you'll get the right answer. You compare those. Be careful on that though, because the monthly is going to go, 120 rows, but the weekly may go 500 rows. Some students make the mistake of adding up the payments 120 rows, and when they copy it over, they forget to extend that down to the 500 rows, and they say, "Oh, wow, it's like $80,000 cheaper." They can know you didn't add everything together, right? So those are some of the tricks that you'll see. What I'll do, and don't worry about the applications yet. I want to get project one behind this, but I can't give you much feedback on the applications because there's so many of them. But if you get 85% on it, I do keep tracks of what you missed. Maybe this time I'll start, I might do this with this class. It's just putting comments in Canvas, and you divided your interest rate by 12. You should have divided by 52 because it's weekly, not monthly, something like that. What did I count off for? Because I want you to know what I counted off for, not so much for the grade, but more so you know what you missed. A lot of times students just miss just sloppy stuff, not going too fast. You'll each get your own applications. That's why it takes me a while. So you'll have your own set, just so I don't want people like sharing files or anything. So, so I'll have that out to you here pretty soon, but I don't want you worried about it. Nothing will be due on the applications before the exam one anyways. So you'll have that in time and you'll have videos to watch. So even if you forget most of this, if you're an accounting major or a finance major, you should be able to do everything we just did off the top of your head without, other than you can look up these formulas. But it's just become second nature. It's what we do in finance. Now, can you use this in any useful way? How much time do we have? Well, I'll start this. So I built this spreadsheet and it only uses those formulas I showed you. There's nothing else in this spreadsheet. So this is a retirement planning spreadsheet. And this is a person, they think they can make 5% a year. They think inflation is going to be about 2%. They're currently 25 years old. Her name's Carol for some reason. She wants to retire at 62. She thinks she'll die at 95. How do you pick that? I'm going to give you a solution on that maybe next class where Carol can take care of that without any trouble. And then what I do with people when I do retirement planning, I say, pretend you retired today. What would you need in monthly, an annual income to meet our expenses? Now maybe they think, okay, I know I'm going to have at least 20,000 Social Security or whatever. You know, they'll put it all together. But in today's dollar, I don't tell them what are you thinking is going to cost you 20 years from now. This spreadsheet's going to figure that out. And what this spreadsheet does, I use the text function. So it combines text. I don't know if y'all have seen that before, like the 40,000. If you change the 40,000 to 50,000. It just automatically updates everything. So if y'all tried that, combining text with formulas, it's pretty cool to do. So it explains how the spreadsheet works. So she thinks she's going to need $40,000 when she retires. And once she retires, she's going to need that $40,000 to last her 33 years. But will she be able to live on $40,000 every year for 33 years? What does she need? Needs inflation because prices are going up. So she's going to need 40,000, but it's actually going to be more than 40,000 because we're going to inflate that to when she turns 62. And then when she starts taking it out at 62, it needs to grow with inflation. So she wants to know how much should she save on a monthly basis. And again, I use concatenate. So there's two ways to do it. You use a text function or concatenate. I don't know why I use one versus the other, but that's just combining text with a formula. So it brings all that together. She wants to know how much she needs to save on a monthly basis so that when she retires, she will have enough money. I'm ignoring taxes, which can be okay because if you're using a Roth IRA, that's essentially ignoring taxes because supposedly that's going to be tax-free. We don't know if that's the case. And so it walks through the math. So the first question is, if she needs 40,000 a year today to survive on, how much will she need in 37 years when she turns 62? So look at this formula. 40,000 times 1.02, that's her inflation rate, raised to the 37th. That's that future value function I showed you. It's this function right here. The future value, how much she needs when she turns 62, equals what she needs today times 1 plus I to the n. That's usually when you're dealing with inflation. And so that 40,000 she needs today is actually going to be 83,000 when she turns 62. It's a pretty high number. All right. Now the thing is when she turns 62, she's going to need 83,000 growing with inflation until she turns 95. How much does that need to be when she turns 62 as a portfolio? She needs a portfolio that can produce that. So I think it's really cool that you can combine text. You can see how you could use this to teach someone working with you. So if they change any numbers, I'll make updates. So she needs $83,000 in 33 years. I mean, for 33 years, because that's how long she thinks she's going to live. It's going to grow with inflation. And so how much does she need? She'll need 83,000 divided by 12 or 66,900 a month for 39 months. What discount rate should you use? Well, her investment rate is 5%. but she's got an inflation issue. So this is a really cool thing you can do. You're trying to figure out how much money you need today to cover something that's growing with inflation. You don't use your discount rate, that's your investment rate. You use your discount rate of your investment rate minus that inflation rate. And if you do that, you'll get the right number. So here, she thinks you can make 5% on her portfolio, but she thinks inflation is going to be 2%. So we're going to use a discount rate of 3%. But she's doing it monthly, so 3% divided by 12. When we do that, we get that she needs $1.7 million when she turns 62, and that will provide her the rest of her life. And so the question is, what does she need to invest monthly starting today so that she have a portfolio of $1.7 million? And so we're going to use that future value function. Her N is 444 because she's going to work 444 months. Her investment rate's 5%. That divided by 12, she thinks she can make 0.4167. So she needs to invest 1,000, or needs to invest, that's not it. She needs to invest $1,360 a month. Now, can someone 25 years old do that starting out of college? What is that, a year? Can she invest $16,000? What's y'all starting salary going to be? Maybe
That's what you said.
60,000. They say you should save 15%. That's only 9,000. So that's going to be a pretty hefty thing. Now we know she's probably okay because she's probably going to start lower and it's going to grow with her salaries. But all right, so let's see if this actually works. We're running out of time.